7:23, Wall Street is coming off its best week since November. 4 days straight of gains. Woo! Let's throw a party. It was a welcome change for all of your investment and retirement accounts, but it's still going to take probably several more years to recoup the losses that you had. Now, with those good days, I'm trying not to let my emotions color this. With those good days under our belt, some of the pundits are starting to see rays of hope for a recovery. In fact, Fed Chairman Ben Bernanke says if the government stabilizes the banking system, the recession could end later this year. So Joe Krier, president of Krier Wealth Management, is here, says there are plenty of things to be thankful for, but still there are lots of sharks.
Sure, and Stacy's fired up today, so we better be spirited about this.
Yes. Okay, so let's start with the good, Joe. Is there really anything? I mean, yeah, we're in a down point.
There's good stuff out here. You know, I mean, last October when this thing really started to roll and tumble or whatever you want to call it, they started with the first stimulus package, and now we actually have 5 packages out there. And any congressional legislation or anything else, it takes a little time for that to actually go in and affect the economy. So we're just getting to the point where the first ones are kind of going to kick in here. And now if we have a series of things, it is going to help stabilize or support the economy.
Okay, 5 stimulus packages. Do we even know the total of these things? I mean, I know we do, but it's in the billions and billions.
Yeah, depending on who you ask and how you do the math, you're actually approaching $2 trillion now.
Okay. Bond market is improving. I'm going to stay with the positive here.
Yeah, and that's a good one in that, the bond market is kind of the key here. Right now we're having a lot of talk about toxic assets, and actually they're going to get to that this week. But if you can start to improve the bond market, it helps the balance sheet of the banks, and you can see that the banks would start to lend money more if their portfolios look a little bit better.
Okay, and people are reporting that bank lending is also increasing as well.
It's starting to improve, and there's an awful lot of incentive out there for them to lend and for them to actually be proactive about calling mortgagees and saying, hey, do you need to rework this loan a little bit? You know, they're actually getting $1,000 for those phone calls when they make them outgoing and say, let's work on this before it becomes a disaster.
Is it okay, because we talked about this last time you were on. The banks are getting incentives to try to rework your mortgages. Are they getting $1,000 a phone call, or are they getting $1,000 per outcome?
Well, it's not necessarily per outcome. They actually have to go beyond the phone call. They have to go out, gather information, and get the wheels turning on this. And if they do actually have a positive outcome, there can be money for each year for the following 3 years. So there's incentive to not only rework it, but also to keep people current on their payments so they don't slip right back into foreclosure.
All right, let's talk about the bad. Housing market still in a slump, huh?
Yeah, it's going to be a little while here too. You know, I mean, we'd all like to think, hey, it's bottomed out and we're on our way, but there's a lot of excess capacity out there, and we all know there's empty houses sitting around Jacksonville in particular. It's just going to take a little time to consume that oversupply.
Ben Bernanke even said there could be more layoffs. There will be more unemployment. Right now it's at about 8%. They project it to go, what, as high as 9?
Yeah, it could go as high as 9. And, you know, if you're looking for a silver lining here, anytime the unemployment rate goes above 6% in history, it shoots way up high after that, but it's never stayed there since World War II.
All right, let's keep our fingers crossed with this one. And then retail sales still in a dive, huh?
Yeah, and that's a pretty good indicator of consumer confidence. We know consumer confidence is in the dumps. We're just one consumer confidence reading short of mass suicide here, so that can't get much worse. You know, I heard someone say this morning, if you jump out the basement window, you're really not going to get hurt, and that's kind of where we're at right now.
That's a good way to put it. And the unknown's still out there. Tell me the unknowns here.
Yeah, well, uncertainty is the enemy of the markets, and as long as people don't know what's around the corner. And, some of these stimulus packages have been announced in broad outlines, but the fine details haven't been put in place yet. And we also are still kind of settling into, how the political mix this year is going to work out. And, health care is another big piece of legislation. So there's just a lot of key elements that are out there floating around. And last week was, I think, the first semi-quiet week, and perhaps that's part of why the markets came back a little bit.
Yeah, if we expect any earnings or reports or anything else this week,
we're going to get a few, and I do need to caution you not to get too excited about last week because the bank stocks had gotten just so low. They were due for a little bit of a bounce. And typically when a market recovers, it's due to new leaders that are having strong earnings, not just, old companies that have gotten so cheap, somebody has to buy them and
Right.
lift them up.
All right, Joe Krier with Krier Wealth Management joining us to talk about the good, the bad, and the unknown.